Afternoon, folks. Mayur Joshi, Head of Research at MarketSmith India. A couple of days back, we just carried out a very interesting report in terms of the safeguard duties that the government has imposed, which will be beneficial for domestic steel makers. How does that benefit the domestic steel makers in terms of pricing, in terms of utilization levels? What kind of reaction can one expect from the stocks which have already reacted is something we've carried in our report. So without further ado, let me first share the snippets from our report, which can probably be a little bit helpful in terms of how to understand that. And this is where I think, again, where the report lies. Once you go to the research tab in reports, you will find the latest coverage that we probably got in terms of our research recommendations, as well as the thematic research that we carry. Now, specifically, a couple of days back or 3-4 days before, I think the government imposed a 200-day tax. And what this probably does is it safeguards our domestic industry to a large extent. It obviously targets all kinds of steel products. So basically hot rolled coil, cold rolled coil, coated steel, which is useful both in terms of sectors like flat and long steel, which is basically either in manufacturing or the auto industry. What it basically does is that it expects with these safeguard duties to come in place, the kind of imports that China was happening and other Southeast Asian economy as well, they were dumping raw steel, finished steel, semi-finished steel into the Indian markets and on the Indian shores, which created a huge pricing difference. They were dumping it at lower prices, which made it very, very difficult for our domestic steel manufacturers to ensure the kind of pricing that they had at their behest and ensure the kind of balance sheet dynamics that one really expects. But with these duties in place now, the expectation largely is that there might be an increase of 4,500 to 5,000 rupees per ton in terms of pricing across products, whether it's HRC, coated steel or CRC. Now, as prices increase and because raw materials have remained a large part constant and very stable, it will lead automatically to better EBITDA and better EBITDA margins plus better EBITDA per ton. With better volumes and lesser imports coming in place, our steel manufacturers who had utilization levels which had dropped quite significantly will start increasing. And as that utilization number increases from 75% to 80 or 85%, the operating leverage starts kicking in. Steel makers have been adding capacities as we speak, and therefore I think from a industry and a structural perspective, you'll obviously see some element of benefits happen onto the balance sheet. Obviously, metals have done exceptionally well for the past few months. Base metals had a huge rally. You can see that through all base metals and all base metal stocks, including the likes of an zinc or a Hindustan Copper. And even aluminium has now started moving higher. It has reached almost $3,000 a ton, which has seen reactions in a stock like Nalco as we end the day today, as well as Jindal, one of those stocks which we have discussed in our reports in the past few weeks as well. A couple of stocks which we added in MarketSmith as a clear disclaimer were Jindal Stainless. This obviously is one of the largest players as far as the stainless steel industry is concerned. Large capacities of 4.5 million tons. They're expanding these capacities, has a large market share, less debt equity at 0.2, 0.3 times. Decent margins and EBITDA per ton in the first half have remained very stable. And therefore, I think with the duties coming through, helping steel products, even stainless steel as a proxy and an ancillary to the entire industry, should also see positive dynamics moving in. We obviously discussed these stocks in one of the videos. You can obviously have a detailed look on one of those videos that we have carried. The other stock which we have obviously added over the last few days, again as a clear disclaimer into our model portfolios, has been HEG. Our sense is that for steel making, this is one of the best alternatives for making green steel, because what it does is it makes graphite electrodes useful for manufacturing electric arc furnaces, in electric arc furnaces as a mode. And that is a mode where lesser carbon dioxide is emitted, 1/4 than the normal steel process. And therefore, I think with input costs again, specifically needle coke prices remaining very, very stable, I think earnings, ratings, rankings look solid even for this one. Obviously, technically, in terms of RS rating, And in terms of the placement, absolutely well placed. So again, clear disclaimers, both the stocks, JSL as well as HEG, are a part and parcel of our model portfolios. For a more detailed analysis, I think please have a look through in the report in the link that we've carried. For more research updates, follow us at MarketSmith.